Welcome to the Product-Led Podcast. In today's episode, we're sitting down with Tim Schumacher, co-founder of SaaS.Group, to unpack what it really takes to scale SaaS companies the smart way. We'll dig into the challenges founders face when aligning product, sales, and marketing, the pitfalls that stall growth, and the mindset shifts needed to build companies that last. You'll hear Tim's perspective on building a portfolio of thriving SaaS businesses, what he learned from scaling across different markets, and the frameworks he uses to spot opportunities and avoid common traps. So if you've ever wondered how to create sustainable growth at scale and learn from someone who's helped dozens of SaaS companies do exactly that, this episode is for you.
For SaaS.Group, since you co-founded it, what were like everyone's different skill sets, abilities, and stuff? You mentioned like you love the operations, so I'm going to assume that that's your jam as far as that part.
In this team, in the SaaS.Group team, I'm more kind of I love operations, but kind of from a business marketing, business opportunity standpoint. And so kind of the first person I asked to co-found the company was my CDO co-founder, who is a real product guy. So he's like a really deep product mind who can think about products and everything. And the people who then subsequently followed, one is very technical, he's the CTO, and the other one is an operations finance guy. So we really kind of have all our respective complementary skills. And I think that's really important in a team. I couldn't just run alone. Couldn't imagine that.
Oh, totally. Yeah. It's good to divide and conquer on that end. And what kind of got you, what was like the founding vision for this company? What was like, hey, this is the big need we see in the world? Or was it like, hey, no, I just think it's a good idea, could have a lot of synergy for SaaS companies? Like I always love studying different builders. Like I know like Mark Leonard, probably familiar with him, like Constellation Software. It's like he did VC. We're investing in all these companies that like...
You know what? For me, of course, Mark Leonard, he's an idol for us, and he's a company we really kind of follow. And I would say, there's a role model. It's definitely Constellation. But fun fact is I didn't know Mark Leonard when I went into this industry. As very often as a founder, first you think your idea is unique. I was like, oh yeah, it's so unique buying SaaS companies. And the reason was exactly the same. The reason for me was I was not VC, but I've been doing a lot of angel investments since I exited my first company, Cedo. And it was always there were like a lot of really nice cases, but it was so frustrating very often that, you could tell founders things and they would just ignore your advice, and you knew they're going to hit a wall and they were just destined to do it. And at the same time, we've been paying those crazy valuations. Like they come with a deck and it's like, hey, this is a nice deck. I want like a 10 million pre-money. And it's like, then you get those companies offered by brokers who's like, well, for 10 million, that buys you a $2 million profit company. And I haven't seen that many of my venture or business angel companies to hit 2 million in profit. So it's like, okay, I'm an operator and I think I could do that.
So I guess what was your unique way to differentiate, just for like anyone that doesn't know SaaS.Group? Because there is a lot of like big PE companies you'll hear, like Vista Equity, Constellation Software. Like Constellation's like, hey, you're like a mission critical piece of software. We're not really going to touch much of your operations. We're probably going to fire most of your team, run it just for profit. And majority of their growth just comes from acquiring new companies. It's very little organic growth. I think it's 5 or 10%. There's like Vista Equity, which is like, hey, we have the playbooks. Our playbooks are locked and loaded behind the vaults. And that's like our crazy IP. And we add a ton of value. And then where would you say like SaaS.Group is like, hey, this is our unique playbook, and this is how we differentiate against some of those other players?
I think one of the things that is differentiating us is really kind of the size of acquisitions. Although I think Constellation is in a very similar playing field. We do small acquisitions, usually from 1 to 5 million in revenue. We've done a little bigger than that. We've done a little smaller in the beginning, but really it's kind of our sweet spot is probably between 3 and 5 million these days. And a lot of players don't touch deals of that size. Then contrary to Constellation, actually a lot of other players like Banyan Software and others, we don't go into those super deep vertical enterprises. We kind of touch those things that are mission critical, but kind of the next generation mission critical. So online marketing tools, development tools, productivity tools, those small little tools we all use, like the software we're on at the moment, Riverside, to record that podcast. That could be this kind of software. You probably pay a couple bucks a month, but it's not huge, but it's still mission critical for you. But would you change it if they raise the price a little or something? As long as they're stable, doing a good job, you're probably going to keep using that forever. And we do a lot of those things, but kind of the more modern stack, more PLG stack, but with similar economics and just smaller ARPUs.
Okay. And I guess from the beginning, was it always like, we're going to invest in product-led companies, or is it just like, hey, we just tend to work best with them for the most part? Like, where did that kind of come into play?
I think it's kind of happened kind of organically in a way. I've never been like a heavy enterprise sales guy doing kind of mission critical software and selling them in sales cycles that take 1, 2, 3 years if you sell it to big corporates. I've always been someone who liked building products that sometimes have high tickets, but still product-led. Like my first business was a company called Cedo.com, a domain marketplace. And I'm sure like many entrepreneurs are still familiar. It's the biggest domain marketplace in the world. And you can go on there, you can buy domains. And we've sold to a lot of enterprises. I mean, we've sold like big ticket domain names for millions, but still fairly similar process to buying a $99 domain name on the secondary market. Also the next business I started was the company behind AdBlock and AdBlock Plus, the world's leading ad blocker. And again, it's kind of a bit more consumerish business. So it's just probably what I gravitate to.
Totally. Were you always investing like majority in SaaS Group, like to get the majority stake in the company? Or is it like, we have to get 100% of the stake, or is it minority? What's that typically look like?
So it's always majority, and actually it's always been 100%. I'm not saying that that's the only model we would ever do. We've had deals where we contemplated doing a majority and then some put call option to acquire the rest. But fact is, it's much easier to have a streamlined company if you own 100%. Secondly, the type of deals we do, mostly deals where the founders ultimately want to transition out. Some very quickly. We have people who are like, okay, I'm burned out. I can't do that any longer. We've had people who are like, I want to become a woodworker. I don't want to have anything to do with this internet stuff anymore. People who are like saying, okay, here are the keys. You have 4 weeks and then I'm gone, and then never ask me again. And we have people who've stayed with us for years and still are with us. So, and both is fine. There's nothing is right or wrong. I think I'm a strong believer that you should do what like matches your personality, your lifestyle. We have people who were really great at 0 to 1. They build something and then that's what they're really good at, but they're not good at scaling. It stresses them. It burns them out once they have to hire people, once they have to answer a lot of support emails, once they have to start really building in structures, and they hate it. But they're kind of a victim of their own success. They have golden handcuffs, very much like the corporate world does that with salaries. A company can do that to a founder. We've seen that multiple times. And so they transition out quickly. And of course, we have to do different deal structures. We can't do like long earnouts, or also sometimes it's of course not advantageous for the price if something is really kind of a fire sale. But generally we can do everything. And we believe we want to work with a founder who's really motivated. If he or she is motivated, we like to work with founders for a long time, but then we usually find kind of some long-term incentive programs and earnouts, but still do kind of 100% deals.
Got it. And so where do you hope SaaS Group is in like 3 years? Like, what does that like ultimate success look like? Obviously 3 years is not ultimate success, but like that big shiny like goal for you and the rest of the team that's like super inspiring to you.
Yeah. I read an interesting quote from a business coach the other day who said like, and that really kind of resonated with me. And it said like, founders are often much happier if they don't focus on this ultimate success outcome, but
right, because they're living in the
they
gap.
instead focus on the path. And that's very fitting to your question, because I hear that a lot also from startup founders. They're like, oh, I want to have this founding round and then everything's better. And once, I have my Series A or whatever, or I want to have this exit. And I get it, because like the first exit was like one of those goals for us back in the days. But actually, I think it is actually a lot more the path, what you're on. Is like, are you enjoying what you're doing? You have like a great team. You like to work every day. And I think we have that. And so I can't answer your question, to be honest. I think for the next 3 years, we're just going to continue to do what we do well, is acquire companies, treat the founders well, treat the company well, grow it, make money that way, but also have fun building this. And so, 3 years down the road, the company will be bigger than today, but probably also in 5 years or 10 years. And maybe at some point we're going to do an IPO or just keep tugging along. And I think there's no ultimate success. And that's what, for example, what I really like about Constellation. They're like really just focused on every year. They do a bit more and they're really disciplined. And I think in that way, they're a bit of a role model.
Yeah, definitely. And you remind me of, there's this book called EOS Life. I don't know if you've heard about it, but it's like 5 principles of like success, essentially what you're referring to, like that journey. It's like, do work you love with people you love, make a big impact, get paid fairly, have some time for hobbies. And it's like, I kind of adapted that, added like maybe 1 or 2 other things. Like for me, travel is very important. So like, I get to do that wherever I want, not just work I like. And so, it's kind of fun when you live life based on those principles, because then you can look at every day and be like, am I successful today? And it's like, well, did I check the boxes on those things? And it's like, it's actually quite easy to do that. So I love that it's focused on the paths as well, for sure. But how do you, like, to push back on that devil's advocate, how do you inspire the team around that? Because there's like sometimes getting them bought in, they're like, hey, here's the vision of where we want to go. And if you're just like, hey, we're going to enjoy this journey, we're going to obviously grow a little bit. I imagine that like could be potentially a little hard for them to be like, okay, is that, I need to acquire 100 companies this year? Is that 5? Is that like, sure, we could grow a little.
Oh yeah, no, but I mean, we have goals, dog. Great question. We have goals. I mean, we have a goal for every one of our brands for this year and next year, and we have acquisition goals. We've met them in some years, but this year, for example, we've just acquired 3 companies so far, probably going to be 4, but it's falling a little short of our goal. And we know what we need to do to ramp this up next year. So I think that we know you have a fair point. The downside of a continuous business like that is that you don't have this one goal everybody's working towards too. So you need to kind of create a bit of micro goals. So for example, one of our goals is reaching 100 million in revenue now. We're at about 80 million now. So there's still some room, but it's one of those milestones. And technically, I mean, it doesn't mean anything. Life will be exactly the same whether we have 80 million or 100, but it's kind of something we'd all be proud of. But you do raise a good point. Is motivation, and that is, to be honest, is something I sometimes struggle with, because I see on the venture side, I see a lot of the climate businesses, and they have a very clear goal of doing their part in solving climate change. And that's usually very, very motivating for the teams. And I'm sometimes like, hey, I wish we had something similar, like in terms of ambition. And that's much harder, I would say. It's software, and especially it's harder in this distributed software. If you have one software, it's usually you have a really clear product vision and something where you want to go, like which target group you want to enable. And from a group level, it's definitely harder to phrase that. And it's, to be honest, something I sometimes struggle with when I speak in front of the team, and I want to bring the same enthusiasm I have on help, but it's harder with a topic like that with others.
Totally. Yeah, because like with World Funds, and we were talking about that at the beginning, it's like very clear, like the environment's green, like that impact is clear. Everyone could know that. But then for SaaS Group as a whole, I think you almost have to like zone out to core values or something like that. Like, no, we're just obsessive about growth or something like that. Like it could be that, it could be something else, but that is the thing that applies across everything.
Yeah, and absolutely. And we have that. I mean, if you go on our website, we have 4 core values, and a lot of them are actually also built towards the way we work. We're a fully remote company, which has a lot of benefits, and it's beautiful, but it also has some drawbacks. But it just lends itself to a very peculiar type of managing an organization with a lot of transparency, very radical transparency, radical honesty, and a lot of independence. And those are all our values. And because you can't otherwise operate a remote company without those values. And that is fulfilling for many of us. It gives us a lot of freedom. You mentioned that you travel. Well, a lot of our people are the same. We have digital nomads. We have a lot of people who live in another country than they were born. Probably, I would say the majority of SaaS Group, because that's just the type of work is much better. It's sometimes hard. Like you move to a new country. It's harder to find a job, but it's easier to find a remote job very often.
Oh yeah, definitely. And like a lot of times,
in lower cost countries. So we have a lot of people in Portugal, in Spain, Vietnam, for example, and all beautiful countries, but they're not the highest paid countries.
Geo arbitrage is beautiful.
Exactly. And those are super smart people. If you like to travel, if you like to live in different countries, it's my argument, you have a wider horizon than most people. And to me, this is a real benefit in your mindset, your openness, your ability to adapt to certain cultures. And I think that's part of the foundational we're built. And so back to your point, you made a very good point. Is really we're focusing a lot more on how we're doing it than the what we're doing it, because at the end of the day, software is useful, but it's also a bit boring. But the why is quite interesting.
Yeah. The founder of Vista Equity was like, all software kind of tastes like chicken. Like it's different flavors of chicken, but it's chicken.
It's chicken. Yeah. That's very true.
Yeah.
That's
true. Fun. And so what I would love to do is just kind of draw out over the last, how many years has it been for SaaS Group? It's been 7 years, 9 months, according to your LinkedIn, as far as that whole journey. So draw out from like year 0, essentially, like getting into it, to we'll go to year 1. Like, what were some of the first things you did? Because like looking back right now, it's like, wow, that's amazing. You got like 80 mil ARR. That's fantastic. Many founders are just like, oh, that's incredible. But I think what a lot of people miss is like sometimes the early journey of what it took. And then just what were some of the first steps to get started? Like you mentioned already, you're like, yeah, we started with smaller companies under $1 million. Now we've kind of upped that once we, de-risked it and figured it out. So yeah, why don't walk us through just like the first year? What went on? Did you have like all your co-founders start at once? Did you add some others? What did that look like?
Yeah, it's a great question, because in retrospect, things always fall into place, or sometimes fall into place, but the first year or two are always the hardest, and they have been for every single startup I've done. For SaaS Group, and that was part of the original idea, I wanted to kind of leapfrog that first year by just acquiring something, to not having to go through that sometimes very rough patch of getting the product off the ground, and really kind of spending the first 1-2 years of just acquiring people, acquiring users. I kind of wanted to leapfrog that. And so the first thing really I did is I incorporated the company, and I bought a business. I reached out to a lot of brokers and who were selling SaaS products. And then actually a lot of good stuff came through FE International, and they sent me all those products, or those projects and companies for sale. And there was one which I kind of liked, although I really didn't know the space enough, which was Deploybot. And I liked because it was really stable. The sellers, they're a great company. They also have a couple other products. I like them from a value standpoint. They very much run the company like we run SaaS Group. They're just a small company, but yeah, they're very, very good people. And I always look at this. I always look at like, do we get along with the sellers, and do they have a similar culture? Because at the end of the day, you will have a couple people moving over, and its culture is really important. And so it ticked a couple of boxes. I really didn't understand the business that much, but I was like, okay, I'm going to figure that out. And I bought this business. That I did with my prior exit proceeds from Cedo. And so it was all my equity. And then I hired someone to take care of the business, who was a developer knowing this, and started improving a couple things on the marketing side, on the business side. So pricing, the business itself, moved it over to Stripe. So lots of little things, but they all kind of brought some incremental value. And then the product was stable and it was fine, and it was just churning out money every month. And I was like, okay, now it's time for the second one. A couple minutes later, and that's then when I asked.
Later.
Sorry, a couple months later. Sorry,
yeah, I was like, that's quick.
That was quick. Yeah, AI. In times of AI, is like, it was all an agent. No, a couple months later, and then I asked Ulrich to join, my friend, CEO co-founder, because I felt I need someone, kind of judging from this first experience, I felt I need someone who I really have as a sparring partner for product, who can really deeply think through a product. And he joined, and then we together acquired a second product, which is Juicer. And we still own both products today. They've both grown a little since then. They haven't really taken off like big time, but there was also never the intention. The intention was always just keeping the product stable, grow like 10% a year on average, and maintain profitability, and then use those profits to finance new acquisitions. And then with the third acquisition, we actually started, and we still do this, resorting to debt as an additional financing vehicle, because of course, with buying companies that come with a 4 to 5 EBITDA multiple, it takes usually 4 to 5 years until they amortize, unless you really improve something radically. And so that actually helps then acquiring businesses faster. And we started taking on some debt on this acquisition. And that's been kind of our model ever since, is a mix of reinvesting our own profits, some debt, and also some equity injection over time to acquire new businesses.
So for that breakdown, like in each acquisition, obviously it's different, like the mix of like, okay, how much of what we're paying for this company is profit versus debt. But if we were to take, like, let's say one of your stock examples where it's like, okay, it's a $1 million annual recurring revenue business, EBIT, just to keep numbers simple, is $100K. How do you value that? And I know I asked the same question to Derek. He's like, oh man, the formula, EBITDA times a certain multiple, could be the very simple answer, or it could be something a little more, it depends on the team too. There's obviously a host of different factors you obviously look for on this end, but let's talk maybe a bit about that. Like, what is your deal box of like, this is a green light, this is something that is investable? Because there's a lot of 1 million annual recurring revenue businesses out there where I'd argue they don't even have product market fit, although it sounds like they do. It's like, well, you got 2 big enterprise customers, there's $500K, and then you got like maybe 10 other smaller ones or mid-sized companies. You're like, it's not quite even 30 customers. That's concerning. Potentially, it's like from a risk profile of if some of those big companies leave, it's
exactly. And we've seen a few that had that customer concentration, and that's usually also a sign that the company isn't really product-led, but it's sales-led, or it even is almost more kind of a combination of enterprise and service work. There's some exceptions, but very often that's the case. So, I mean, yes, we have that checkbox where we have obviously a whole bunch of criteria, but really kind of 6-7 main criteria, which is kind of what we look for. Yeah, number one is just overall size, like 1 to 10 million, and in AR, that's simple. Then generally we want that AR to be rather stable or growing than, of course, declining. There could be reasons for a short decline or something, but generally kind of in a declining market is definitely a lot harder to turn around. It's also, I mean, it is a reflection of a price. Of course, a highly grown business will command a higher price, and a low growth or declining business will be lower one. So we don't completely rule it out, but it's of course favorable to grow. Then profitability, and that of course is usually a direct factor of how efficient are you as a team. And that's the funny thing, is like we see 3 million ARR businesses. By the way, 3 million seems to be kind of almost a ceiling a lot of founders hit, and then they're like at 3 million, and then they're kind of stable. And we see 3 million businesses with 30 or 40 people, and we see 3 million businesses with a single founder who is just a lone guy, or maybe he has hired one customer service person to help him. But we've seen also people who haven't. So it's really everything.
30
everything
to
in between.
50 company is sales led, and the other
No.
Wow.
They are product led, but then they start kind of going down the enterprise sales and the enterprise route, and they have suddenly 10 salespeople also selling there. But the product itself is product led, but they think, okay, by talking to people, they can really accelerate things, and then they usually just bloat the entire organization. And yeah, then the only chance if we acquire them would be really to have to scale the operations down and make it 10 people. And usually that works because 30 is very often a bloated organization. If we only have 2, it's the other way around. We need to build up the team because then usually like with a brilliant founder, you can work with 2 people. But usually if you build a team not reliant on the founder, you need a couple different skills in the team. So you end up with more like 5, 6 people. So they kind of converge from both sides in a way. So really kind of the size of the team tells us a lot. It's also a lot more manageable to have a smaller acquisition, to have kind of those lean, efficient teams. And of course, also with higher profitability, it's usually better. Then we look at, of course, the quality of the product. Is it a bad product they've just been selling and marketing well, or if this is actually a great product where people have been able to have genuine fans, build community, have some word of mouth, and is really a great product which we can then help push into the market. So yeah, lots of different factors, but in the end, of course, they're always also reflective of price. And so you asked for the price earlier. If you look at EBITDA ranges, we've bought businesses from 2 times EBITDA, really kind of a difficult business, which was almost about to collapse technically. By the way, it's one of our best businesses now, but back then it was really kind of at the brink of collapse. And we bought it during COVID. So it was kind of everything aligned. But we also had businesses that had an EBITDA multiple of more like 15 or 20 even, because it wasn't very profitable. We thought, okay, by slashing some costs, we actually can get it into the zone of profitability very quickly, and everything in between. And same for ARR multiples. We've paid everything from a 1x on ARR all the way up to 10x on ARR. Majority really kind of being in the 2 to 3x range. So paying 2 to 3 times AR.
Okay. So to recap, your like 1 to 7 kind of criteria you look for. There's the size of the company. So between 1 to 10, the ARR, like how stable is it? Is it growing? Is it declining? Profitability of the company. So how efficient is your team? There's the quality of the product. And what were the other 3? Maybe I glazed over them.
Team size was 1. Oh, and churn I haven't mentioned. Churn, of course, is a big factor. Is do like even to consider 2 companies that are both growing at 10%. One might have no churn and just add 10% every year. The other one might be just churning through half of their base. Just happen to add then 60% new clients. Net is also 10%. Of course, the first company is much better because it's a stickier product, and we know that even if marketing would dry up tomorrow, customers would still use it.
Totally. Okay. So I love that. And so out of the 80 mil ARR, I think I saw on your website you have 35 companies?
25.
25. Okay. Got the first digit wrong. Okay. So out of those 25, what is like your average like goal for some of these companies when it comes to how they run, how they operate? I know you said you love the operations side, but is it like you kind of mandate like, hey, all, cash flow businesses like got to run at 50% EBITDA or something like that? Or like the growth stage businesses, like do you have it kind of broken down internally out of those 25 businesses? Like there was a McKinsey like blue grid. I don't know if there's like cash cows, growth businesses.
Yeah, the cash cow, the BCG matrix. Yeah, it's cash cow, dogs. What else? Growth stars and question marks. Yeah. Well, a little bit that plays a role. I mean, we look at every company individually, kind of what can they do in their given market with their given resources, and we have some businesses which we really optimize for profitability, and we have others where growth is really important, and we feel that we should be investing. Generally, we're a big fan of the rule of 40 because it kind of shows that there is this balance between the two. The rule of 40 says margin percentage, so EBITDA margin plus growth, which is kind of funny because it's kind of it's two numbers that actually have nothing to do with each other. One is really a profitability of something, and the other one is the growth from a year-to-year basis. But still, it really shows this kind of trade-off between growth and profitability. And we steer the majority of our businesses with a rule of 40 and above. It doesn't always work. Sometimes we have businesses that fall shy of that number, but we have everything from rule of 40 up to rule of 100, which means a company grows 40% and makes a 60% profit margin, for example. That's not unheard of, but of course it's the exception, not the rule.
Okay. So if I understand the rule correctly, you have like, if it's the rule of 40, you have the kind of mandate is like run at 40% EBITDA while growing 40% year over year.
No, rule of 40 would be mean 20, grow the company 20% while maintaining a 20% EBITDA margin. And that's we would kind of consider baseline. And even that 2020 is a good baseline because and then you can shift. Like you only grow 10%, well then you should make 30% profit. You don't want to grow at all, well then at least 40% profit. And so kind of companies can choose to a certain extent. Sure, we have an opinion, so that's actually something where we engage in a dialogue then with a brand manager to find what is the right strategy. And there really isn't the right or wrong. There are like we need profits as much as we need growth, and it's really just always figuring out is like what is actually profitable, efficient growth. That's really kind of what we're looking for, because what we see in the VC world is a lot of non-profitable, non-efficient growth. Sure, you throw enough things at something, you're going to grow.
Yeah.
Will you grow enough to justify the next valuation? That's the big question mark. Will you just grow enough to leave something for the founders once all the liquidation preferences are satisfied? You also don't know, but you grow.
Yeah. I was looking at Twitter or X about like the AI bubble. There's like ChatGPT is paying this much for each prompt. And then Replit is going off of that one and they're paying this much. And then like the next AI tool that's like subsetted by Replit. And then you're like, if one of them, increases price towards where it should be, oh, wow. Like it turns out AI is not that cheap. But I mean, if you're betting on like Moore's Law and everything else that's developing, like it should come down. But right now it's definitely infused with VC dollars. That's for sure.
That's right.
Totally. Well, I love that rule with the 20 over 20, or like if you're thinking about like, okay, we want to have 30% EBITDA. Okay, expect like 10% growth. Of course, the math and how that actually works, you might have 20% growth still, but it gives the person leading the company a bit of a rule set of like, hey, just kind of expect these things. I never heard that before, so I love that. Now, tell me more about your post-acquisition playbook, because the very first company you had bought it with your own money from the previous exit, and then you kind of went in, hired somebody else to kind of help the developer to kind of get things executed, got it to a stable point. Then you left for the next acquisition. But what does a typical acquisition look like? And on the post-acquisition side, so like when you fix it up, maybe it's like you mentioned the first time, like, okay, we're changing things. You're going to use Stripe now. And like, I imagine there's some standardization of like some tools, but that's the next question I want to go through, this centralized versus decentralized approach. But let's focus on the post-acquisition playbook.
Yeah. No, that's a very good question. And the post-acquisition, I mean, that's something that has been refined over time. Yeah, the first one, it was more like I looked at the website and the product. I was like, okay, maybe I think we should change this, that, and this. And there was also no formality and no central services. And then over time, of course, we discovered more and more things that were similar between different SaaS products. So even if the service was something completely different, a lot of things are the same. Kind of how you payment, for example, with Stripe and other things is a best practice. How you do pricing, how you market for products. I would say there are 80% similarities, and then maybe 20% things that are unique per every single business. But usually, best practice is a best practice, and also with new things. Like for example, at the moment, a lot is about how do you position companies in in generative AI services. So, how do you rank well in ChatGPT? There is a best practice for that. And like, it's something we're rolling out everywhere because we know it's like mission critical, just like SEO was over the last 30 years. And there are a lot of similarities, and you have that everywhere. Also development and the adoption of AI. At the same time, we don't want to stifle creativity and the freedom to choose and market-based behaviors of the brands. So the brands tend to be free to choose with most things, but that's kind of at their own risk. And there is a set of standards. So we're basically saying, okay, here we're pretty sure that this is the right thing, but you're happy to prove us wrong, but we're pretty sure. And then there are other things where we're like, nobody's tested that, just do whatever you want to do. And especially kind of when it comes to your own product. And most people, and that's the interesting thing in SaaS, is most people pride themselves mostly on the actual product development. So whatever service you develop, so, take a product of ours, anyone, like let's take Scraper API, for example, a scraping service. Then, of course, those people are among the best in the world knowing everything about scraping services, scrapings and proxies and all the different ways to extract data and put it into the right boxes and everything. So that's what they're really world class at. Everything else, how they market their product, how they do billing, how they do a well-converting website, they do it as much as anyone else. And that's kind of where we come in. So over time, what we have done is we've built central services that are really good at those horizontal things. And those are things like HR, finance, BI, but also marketing services, some product services, and the newest one is AI. Because while AI is of course a job for everyone, people really benefit when they have a super specialist who can kind of teach them everything about AI, best practices, be a sparings partner. And so that's a position, for example, we just hired at the beginning of this year, and it's been working out really well.
Awesome. Yeah, I love that focus of like centralized services. When did that come about? Because I know even at Product Led, we have our whole model. It's like we have product led implementers that will implement anything from like a new offer, so homepage for the clients, onboarding flow, pricing, install your product analytics, run your growth process if you don't have that, help you identify like who should you have on your product led team and your product led strategy, user research. There's a ton. And what we realize is like, no doubt, that not every implementer is fantastic at all of those. So there is some ones where it's like, hey, you know what? Having somebody who's just really solid at pricing, has done this again and again, it's a little more rare. So it's like, okay, that should be a specialist. And we're not quite at the point where it's like, okay, we have like somebody full-time for that. It's just contracts where it's like, okay, we'll pull them in when the project makes sense for that specific client. But curious how that came about for you as you were crafting SaaS.Group. Was it like when you had like 5 companies and like they all need help with X marketing site or something like that? How did that kind of come about?
Yeah, it grew organically, like most things grow at startups. I mean, there were a few things where very early on we started, for example, with finance. It's like, because you got to consolidate finances at the end of the day, have proper accounting. And the good thing is also most founders and teams, they hate it. So it's nothing you take away from them. And they're like, yeah, sure, you can do it. And we've got a fantastic accounting head, and she's been doing that for literally the last seven years. And so that was one of the early functions. And at the beginning was just kind of the one person, or not even one person. I think she did halftime. And then it over time developed into a full-fledged finance function with now everything from tax to audit to payments, whatnot, budgeting, FP&A, and a lot of other things we have there. And other things were essentially stuff I've been doing, like marketing, for example. At the beginning, I've been trying to kind of guide them with I have some marketing knowledge amassed over the years, but also I'm not a super specialist in any of the topics. So a lot of them was also guessworking, pointing them to the right directions, hiring the right freelancers. And then at some point we're like, okay, well, actually it would be cool to have a CMO to take care of this. And so kind of that person then took a lot of the stuff that's already there, but kind of made this into a professional organization, which we have now. And then it's very much also demand based. I mean, we have marketing is a great example. We have teams we acquire who are really good at marketing. They might just need one specialty. They're like, okay, we need help in technical SEO, or hey, we would like an SEA account RSA or Google account to be managed because that's really kind of a special thing. And then they hand that off, but the rest they run in the brand. And then we have others, they have no marketing at all. They don't like marketing. They're like, okay, marketing central, you run this. And we're just going to give our input from the product side. And both works. It also depends a lot on the size. Some of the teams we have are 2 people and others are 20. And that, of course, is a different story.
How do you manage the dynamics of that? So you have centralized services. I imagine that's paid directly from SaaS Group. But then let's say, hey, you have this new company that you acquire and they're like, actually, we need a ton of help on all of these specific things. And then long and behold, your centralized services is like inundated with just this one company. I guess maybe that's a little normal of like at the very beginning, it probably should be like that. But I'm curious about like the financial intercompany dynamics, or you just treat us all like, hey, we just help whoever has a request kind of thing.
That was like, it was like that at the beginning. It was like, we help whenever we have a request and we pay everything. But of course, it's always a thing if something doesn't have a cost, demand is infinite.
Yeah.
Marketing, whatever demand, sure. As a brand leader, you'd be stupid to not take the maximum. And also, you never know if your central team is actually doing a good job, because if something is free, well, people will take it. Can't blame them. And so I think about 3 years ago, we did what all companies or bigger companies do at some point. Yeah, do intercompany pricing and be okay. You want marketing services, it's that much. You want recruiting services, every hire costs you, I think, $3,000 is what we charge internally, which is actually super cheap. Like it's amazing. Like recruiting, for example, is one of the muscles where we have like an amazing recruiting team. They're amazingly fast. They know the company really well. I also we never work with outside recruiters. I'm a really big fan of in-house recruiting teams, and they work fast and quick and at a super affordable rate. But they would have to prove themselves in the market. If suddenly they would charge 30,000, people's like, well, why? We gotta get some headhunter because they do it for half. And that has happened. Some services have disappeared because there was not enough demand, or they were too costly and the people just didn't order them. And it's like, okay, seems like there's no demand. And I'm really a big fan of the market principles also within a company, because otherwise I think an organization becomes very bloated. There's one cool book, by the way, that has inspired me, Humanocracy, which I read. I read it about 2 years ago, but it really was like, it was kind of a scientific blueprint for a lot of the stuff we've been doing. But I also learned a lot about how other companies have been doing that. And it was a lot about those independent units that really work in a free market. And you don't have those bloated organizations where you have very little accountability and responsibility within the respective markets, because especially in central teams, it can lead to them being just monopolists. And that's usually never good for quality.
Yeah, I'm going to read that book. That sounds fun. I know I was talking with the visionary at EOS, and they recommended like reading The Starfish and the Spider as far as like centralized versus decentralized organizations. And so learned a ton from that one too, but I'm excited to read that one. So for centralized services, you have recruitment, finances, and then like stuff on the marketing side. Is there any other like core services where you found like over the years, like, hey, this one hasn't changed. People just always need to have this centralized, and it could just be really core to your culture, like the people piece. Like, hey, if we centralize that, we can kind of instill, hey, we're screening people for the core values that we have at SaaS Group. And so there's a little bit more of like an incentive to be like, hey, that's going to be centralized. You're going to get somebody great, but they also mesh with who we are as a company.
Yeah. No, and exactly what you just said is people is crucial. Having core values, having core principles, also having transparency. I mentioned radical transparency earlier. And part of that is really also having proper feedback processes. I'm a big fan of that. We do biannual surveys and also biannual reviews. One is lighter, and once a year is a really full 360-degree review. And that's really interesting in a distributed organization to discover truths and hidden people in both good and bad way, which otherwise just wouldn't surface because you wouldn't see them, but also have metrics across the organization where okay, we have a problem here in this team. There's some team leader and something is wrong there. We got to really look into this. Or otherwise, hey, we have this hidden talent over there and he or she is doing an amazing job. We should really do something and give that person a great path. That person can do more. And so really, but standardized metrics across the board. And that's also one of the things where there's no freedom to purchase it. Those things are very, very, they have very small costs, or they're even, some of the things are completely taken over by central cost wise. But we really need that input to run a proper organization. Also, people analytics is super important. There's a tool we're using called People IX, which is super cool people analytics tool where you basically have all the information at your fingertips. And that's super important at a distributed organization with also different culture, different history through the nature of roll-ups. And we couldn't work without that. So people, to your point, really the people HR team is a team which works more standardized across the board than other teams. Also payroll, those sorts of things. You don't want to leave that to individual companies. And frankly, they also don't want to. They're very happy to have a competent team taking that over.
Definitely. And is People IX what you use for getting those performance reviews that you do twice a year? Or is that like a different tool, or is that just
that is a different? It's just a survey tool. That's very simple. But the more interesting thing is the analytics piece of really kind of finding out everything about people, and from performance metrics to attrition metrics, fair pay, lots of topics, and kind of how you can actually dig in people data. And that's one of the things which I find super fascinating is how much analytics there's out for anything, website analytics and marketing analytics and finance and whatnot. But people, which is really kind of, it's everything we have in a software company. It's all the value, but it's also almost all the cost. How little attention and proper analytics it always gets in most companies. So
yeah, it's your most important asset, yet you have the least analytics on how are you doing? Okay, so with the performance reviews, super interested in that. What is there any resources or anything you recommend to kind of check out to get really good at that part? Because I think a lot of people listening, it's yes, they hear performance reviews, but then it's well, doing them, executing them, they just want the easy button. So I'm curious.
I don't know. There's an easy button. The tool we use is really just a proper survey tool. We could use any tool. We've actually thought about transitioning to one of our own. We have 2 customer feedback tools, User, Snap, and Zenloop, but they are made more for product feedback. But we could easily use them. We've actually thought of transitioning to our own tools because it's really just a survey tool. And in terms of what is best practice, it's also not rocket science what we do there. It's just a bunch of questions. And I think, but it's not a lot. It's 4 or 5 questions. What's the best thing that person has done in the last year? What are the things, where that person needs improvement? What's the path for the person to move forward and so on? So really very limited question. I think the core is really just doing it, is the discipline of meticulously scheduling time every year or ideally every half year in an organization. Make sure really everybody does it. And it's not about getting too hung up on formality, on how you do it, exact questions, but it's about putting down a few bullet points and then taking the time to talk in a dedicated way about feedback. Because of course, we give feedback all the time. I say, great idea. Or I said well, yeah, okay. We say that all the time, but actually giving proper structured feedback, I think is such an important thing in management. And also receiving feedback. Also for me, it's of course super interesting to always get feedback from people on my skills. By the way, giving not enough feedback is always in there. It's every time I'm shit, I've tried to give feedback, but that's kind of where I'm scoring low. And so I think, and most people actually do. So I think it's really important to take the time, and the discipline is more important than anything else. So the combination of putting it down in some structured form, but then also just talking.
Yeah. I love all these people operation tips as well. And speaking of people, I'm sure one of the most important hires you have to make is okay, if the founders of one of the companies you're acquiring leave, who is going to run that ship and be the CEO? I don't even know if you call them the CEO or the GM or whatever, the person who's going to lead that charge. Tell me more about how you hire this person, or is it usually a promotion for someone who's already at that team? How do you typically find that person and then incentivize them to really grow that company?
It's an interesting question because we've tried multiple ways of finding people. We have had internal promotions. I like that. I like internal promotions as much as possible because people are tried and trusted and we want to have internal paths. We have had founders continue. We've had, for example, the founder of MyWorks software, now over 3 years into the acquisition. He's still with us and he's awesome. He's like great. He has done an add-on acquisition and coached new founders and has really kind of also moved the product further in a great way. And very often we have the second in command taking charge, which is an interesting dynamic because if you are in a small company, now the company has 5 people, 10 people, and there's a founder, then you have the interesting dynamic that the founder is like a glass ceiling. It's like really hard. You never get over that until that one day when the company gets acquired, the founder leaves, because then suddenly it's like, okay, oops, now I could be that person. And we've had cases where it should be that person. That's what people sometimes think, but sometimes they also know that there's a limiting factor. As founders, especially the ones who are charismatic and going forward, they usually need someone who takes care of a lot of the operation, the classic COO role. But those people also often have limitations that they might not be that product focused, that people focused, or whatever other qualities the founder had. Not always the case, but it's a bit of a generalization, but very often it's the case. And so I've seen cases where this went really well, where the COO was actually the better CEO, where the founder was just all over the place, disorganized. Just sometimes those super creative founders, they tend to not be good company runners, and then the COO takes over and he's better at everything. And we have other cases where we're like, after years, like, okay, there was a reason why the COO was only COO. And that's okay. But then, we'll try it out. And sometimes that person goes back into command. And often we also hire from the outside. What we've had very good experience with is hiring very technical people, because you can learn the business part. It's not that rocket science, but being a builder, being a doer, being someone who doesn't just talk, but actually builds product, codes things, especially these days where, you code agents to sell things, to answer customer service queries. Like, you actually need builders, and we love hiring very technical people and who are good journalists and then putting them in charge. And very often that's what's been working incredibly well.
And do you have I know McDonald's has Burger University, but is there any
we
sort
have
of
SaaS Academy?
SaaS Academy? Yeah. Your own SaaS Academy or Dan Martell's SaaS Academy?
SaaS Academy. Well, it's virtual only, but we are doing things like, for example, next week, the entire leadership team, so brand leaders, central leaders, about 35, almost 40 people, going to be meeting in Gdansk in Poland for a whole week, and some parts will be management and other things, but a lot of things it's just about exchanging ideas, and then there's going to be a whole day of formal leadership training and training. So we do a lot of those things to move our people forward, and that's super important.
Totally. And how do you incentivize them? So is it usually just hey, here's somewhat compatible base, and hey, if you get these profit targets, here's a percentage or something? What does that typically look like for incentives? Because I know incentives are usually with a lot of people, it's half of the battle. How do we motivate them?
No, incentives are super important. Was it Buffett or Munger, or I think one of them said show me the incentives, I'm going to show you the outcome. So making sure there's alignment is super important, and it is a combination of a very attractive base plus a yearly bonus based on the yearly targets, plus then some long-term component. And we're experimenting there a bit. We have SaaS.Group, stock appreciation rights program, which is very similar to stock option program. And we also have some brand long-term targets. And so, we're still kind of, as always with incentives, experimenting a bit, kind of what's best. Also, people's life situation is different. Some people are really, I need cash now. I don't know, building a house and have an expensive family, and is they're siding to that. And others I I really want to have a lot more stock-based compensation. I can be more frugal, and we're a big fan of letting people to a certain extent choose between these, but it's always a mix of the three: base, short-term, and long-term incentives.
And so with SaaS Group stock appreciation program, tell me more about like how you're thinking about that, because we actually, one of our implementers today like raised a really good point. It's like you get paid based on like the clients you manage and everything else like that. But he's like, we love collaborating with each other, but there's no incentives here. And so I'm like, okay, noted. We need to address this. And so I'm thinking just in the back of my head, I'm like, I think you're onto something with the like overall company appreciation part there too. But curious how that works at SaaS Group.
The stock appreciation rights program is a simple stock option program. You get a certain grant at the current stock price, and then you get a percentage of whatever is the appreciation. Now, that should, in theory, that indeed should build community and make sure we're all working on something together. At the same time, there's no direct impact for collaboration. It's not like, hey, I'm going to help a colleague with this problem and I'm going to get something for that. But in the end, we think that that's also not how the world should work. It's collaboration is really more of a give and take. People give, those people will be given back. Also, by giving, you learn other things, you sharpen your own skills, and it's quite rewarding. And I think good leaders know that things, you always meet twice. I mean, especially in your own organization. So it's in their own interest to be collaborative. And a lot is also trying to be a role model by themselves. If we're cutthroat, business is like, eat what you kill principles, or if we're like, okay, we also collaborating, we're helping, that tends to build that culture. Sure, there are always going to be people who's like, hey, this is my focus for this year and I'm heads down and I'm not helping anyone. Fair enough. But I think in the long run, most people realize that humans tend to be collaborative animals and people are better off in collaborating a bit.
Totally. I like that mindset. And what would you say, like, as you build SaaS Group in like next 3 years as well, not back to that goal, but like thinking about like, okay, you're at like 100 mil ARR. What is the moat that you're building? There's the people side. I could definitely probably say, hey, there's something there you're working on, like from the recruiting side to making sure you always have the best people. But what would you say are like the top 3 moats you're going to build that will make SaaS Group unstoppable?
Every business should have its own moat. So every brand should have something where they're really kind of the best in the world. And sure, some businesses don't have that, but we have a lot of those businesses. Like take Scrape API, which I mentioned earlier, is really world class in scraping, or pre-rendering service, which is important for bigger sites to be then found in SEO. They have moats within their own business on how they do it, how they build things. And then, of course, SaaS Group is always the sum of the parts. Then, of course, there is the overall SaaS Group component. And there, probably M&A and our ability to source businesses, transact in this small segment. Because I think it's one thing to buy $100 million businesses where you can throw a lot of attorneys on, and that's one thing. But what we've become really good at is buying small businesses in a very efficient way, and then also improving them with a kind of a proven playbook, which we have quote unquote industrialized over the years and which we can execute with smaller targets. That is somewhat of a moat. It's really kind of across the board. Plus, of course, the sourcing of people and building a system where we can operate with, at some point, hundreds of small businesses, but we can still operate them in a meaningful way. And I think that system to build, that's been taken some time. And I think that's something which is not that easy to copy, because it's easy to do that with 1 or 2 or 3 businesses, but I think it is kind of hard to do this with 25 businesses, or hopefully a lot more in the future.
So if you were to 10x this business, so let's imagine you're at 100 mil already, you're trying to get to $1 billion portfolio in 3 years. What would you have to change?
That's hard. That's a great question. The bottleneck is sourcing the right businesses. And I think we could do it, but I think we would risk of overexpanding and being not very capital efficient. Like, we could buy enough businesses to get this within 3 years to 1 billion. But then we need so much capital, then our leverage would go up. We probably would make more mistakes because we couldn't hire the right businesses. They wouldn't fit culturally, nor could we properly integrate them. Then I think the same would happen as like with any of the venture-backed startups. Some of them we are buying because they had too much money and they were trying to do things too fast and then ultimately killed them.
Yeah, so sourcing the different, scaling the people. The playbook sounds like that. Obviously, refine that, improve it. What would you do differently? Like, it's been almost 8 years going through this journey. Is there anything like looking back, you're like, actually, I wish I did this a bit differently or would change anything? Obviously, when asked that same question, I'm usually like, well, I became who I am because of these things. So there's like that. But if you were to get to, I don't know, where you are today in like a fraction of time, is there anything you do differently?
It's so hard because, of course, there's a ton of mistakes I would have liked to avoid, but you never know those things in the first place. I mean, sure, out of our 25 acquisitions, I'm not going to name any names because, of course, the respective people running it would be disappointed, but there are at least 5 which I wouldn't have done. But it's so hard to say because I remember, for example, pre-render, that business I mentioned, the rendering business, pre-render, like we debated it so hard, like when we acquired it. It was early 2020 and then COVID hit and we really weren't sure about the business because Google at this point was also already saying like, hey, maybe we have, we're going to do this server side. We're going to do that from the crawler side. You don't need to do that server side. And we're really like, do they have a moat or everything? And these days, it's our best business. It's been growing 5x since we bought it, both in profitability and profits. It's doing really well. Product has really evolved super good. We've won amazing clients, great team. There's nothing to love about this business today, but still it was one of the ones which we debated the hardest. Some other businesses were like, yeah, this is a sure bet. They're like, we wouldn't do them again. And so sure, in hindsight, it's so hard, but to generalize, okay, what should we have structurally changed? Maybe a bit more focus. I think my biggest problem is like, I have a certain amount of discipline, but I'm also a victim of this shiny object syndrome, which I think we all often have. There's this target and there's something really cool about this business. And so it's like, hey, let's try it, especially if it's something different because it's a new challenge. And there have been 1 or 2 cases where I've really been pushing acquisitions through just for also having a new experience there. And if we would have focused more on, okay, what is really our ICP, said no to more things, probably we would have been a little better off.
Okay. And do you feel like those 5 were they were outside of your ICP? They were like, we want to try these things.
They were not outside of our ICP. That's the thing. It's not like, I mean, there are 1 or 2 where I know, okay, we consciously went into something. So for example, we bought 2 businesses out of insolvency. And my co-founder and I, we just thought, hey, it'd be cool to really buy a bargain business out of insolvency or like Chapter 11. It's fun. It's a new experience. You get make a real bargain, and let's see if we can do this, if we can tweak it out. And it worked, but it was like it cost so much attention and work. If we would have invested that very same work into the businesses that went well to make it even better, return would have been much better for that. But in hindsight, it's always easy to have those generalization, those rules. But when you're in the moment, it's hard.
Hearing about like Elon Musk's favorite game, and it's Polytopia. And so the whole kind of like game, it's little like you like conquer different villages and stuff like that. But the interesting thing about Polytopia is you have 30 moves. So it's thinking in bets, essentially, of like, hey, if I do these things, or if I expand in this area, or if I expend this amount of energy for this like bargain bin thing, it's like, that's 1 move. And so it's like, is that the right move for you? And is it going to really get you closer to whatever that big goal is or something like that too? So
that's great. I haven't heard of that. I got to look that because indeed it is, because I mean, we think of the business world more as chess. It's a continuous game. We have as many moves as we need. The others have their move too, but yeah, you're right. It is more like, what was it, Polytopia?
Polytopia, yeah.
Because you have a limited attention span, limited time. That's the problem.
Definitely. So your past, before you got into SaaS Group, like you were an entrepreneur, you had your other companies as well, but this was definitely like a new area for you to like go in and build more of a portfolio of SaaS companies. So what were some of like the most helpful resources, mentors, things you did to really level up in this area? You mentioned like the book Humanocracy and just going through that, but what were some of those other things that you found was like, hey, that, there's a lot of crap out there. This is the good stuff.
I mean, there are tons of books I think I've read over time. Humanocracy was more from an organization structure when it comes to actual marketing work. For example, the book Traction, I still like that one from the DuckDuckGo founder. Also, we happen to know each other well because I also run a search engine, ecosia.org, a green search engine. It's a nonprofit now that uses all the profits to plant trees. And so I've been quite involved in that field. But so there are a lot of like those books with very practical, down to earth advice that I think is one of the books that actually stands out. I mean, I don't know. I've read a gazillion books on years. It's always super hard to single one out.
Was there any like great people you followed where you're like, yeah, I kind of want to do like something like Mark Leonard or something like similar where you found like they're really good to study? Like I know Mark Leonard is probably one of the worst to study.
Worst to study because he doesn't publish anything or write anything. Yeah.
Most interesting to study though.
yeah, that's true. No, I envy that if people can be really so focused, like they don't waste their time on podcasts like me. Just kidding. No, I find that super envious to be like that focused. And that's also about saying no, which I think is a really, really important skill in business. And so, yeah, I mean, he's a person, but also other people I touch base with. We have a couple of smaller investors, more like kind of large angel tickets. One, for example, is the founder of Banyard Software, great guy. And so exchanging ideas with great people who are a little further advanced is always one of the best things.
Okay. Awesome. And like, as we wrap up here too, is there anything else you would like to impart on any SaaS founder? Obviously, hey, if you're looking, you're tired of your business, definitely reach out to SaaS Group if you meet that criteria of being a great company with a great product, between 1 to 10 mil ARR, all that fun stuff. But besides that, is there any other like pieces of advice you'd recommend kind of founders walk away with just to think about?
I mean, what kind of echoing what I said a little earlier is that people should enjoy the path and really be focused a lot more on the path of the journey itself, less than an actual exit. Always kind of remembering that starting and running a company is really a marathon and not a sprint. And you can't be miserable during that. And if you're miserable, then I think people should ask themselves why. And we have many people who really love building, but they hate running companies. And then, it is time to go into building mode. And I've seen a lot of founders who go back into that and then be happy again and really have fun along the way and enjoy things. And life is definitely too short to have a miserable business. And maybe one last thing is thinking about capital and how capital efficient you can run a business. I'm a big fan of bootstrapped companies. Most of my businesses, Cedo and also the advocacy company, were bootstrapped. Most of the businesses we buy at SaaS, we buy bootstrapped. It's kind of a little bit of the irony I have on the side, started that climate fund, World Fund, which I also still spend quite a bit of time with, where we back kind of super visionary founders in the climate space. And that's the opposite. We can't bootstrap those companies because a lot of them involve like a lot of research, huge factories or other physical products. But especially in the SaaS world, I think founders should always question themselves, do I need this big funding round? Or is this just because I'm reading about funding rounds on TechCrunch that I want to have that congratulatory headline of, hey, XYZ raised 10 million and this will make me happy for this 1 second. But I've seen so many businesses fail and ultimately the founders walking away with nothing, and bootstrappers don't have that problem. Things are slower, but they tend to end up very often happier and wealthier than their VC-backed founders. And money also has a very diminishing return. Like your 5 million exit, that's life-changing. Whether you have a 5 million exit or a 20 million exit, doesn't really change your life that much. House is going to be a little bigger, doesn't really matter. And so, think about capital efficiency and staying bootstrapped as long as you can. And that ultimately, sure, maybe making an exit or just keeping that company and tugging along. I think that's the much more resilient model as a closing thought from my end.
Yes. And now if anybody could help you who's listening, what is your biggest challenge right now that's like keeping you up at night that you're like, just need to solve this core issue?
I mean, our biggest issue is finding great companies with great people that are willing to join the SaaS Group family by selling the business to us. I mean, we have a lot of open positions as well, but probably finding businesses is the hardest. So yeah, I'm open to any tip, any introduction. Also happy to give advice if any founder is like, hey, thinking about this or that without any business, just email me, Tim at SaaS Group, super easy, or LinkedIn, of course. And I respond to every email personally.
Awesome. Well, this has been a fantastic kind of interview going through things, Tim. I really enjoyed this. Anything else you wish I kind of asked or went through?
No, I mean, we covered a lot of ground. I enjoyed that as well. It was great. Thank you very much.
Awesome. Well, thanks so much for coming on. This was great.